Let me go ahead and pull up the questions from last night. Question number 1, valuation multiples, what is that? So this is a good question. It's one that comes up every so often, usually when I talk about valuation multiples. And I always start by saying this, and people are always kind of mind blown by this comment, but valuation multiples are basically a way of equalizing metrics that allow us to compare one stock to another stock on an equivalent basis. And the reason for that is because stock prices themselves are kind of meaningless. And you may be saying, what do you mean by that? Well, if I tell you a stock is trading at $100 per share, is that a good price? Is that a bad price? Is that cheap? Is that expensive? You really have no way of knowing because the share price itself is somewhat meaningless. And the reason for that is that a company can have any number of total shares outstanding, which means that when you own one share of stock, it could be a totally different percentage of ownership from company to company, depending on how many total shares they have outstanding. And so what we do in order to kind of make stocks more comparable to one another is we use something known as a valuation ratio. And a valuation ratio is simply comparing a metric like price against a fundamental metric like earnings. So the most commonly referenced valuation ratio is price to earnings. And the reason that that makes stocks kind of on a more comparable basis is because you're comparing a share price against earnings per share. And it creates this ratio that then it makes, a stock trading at $100 per share comparable to a stock that's trading at $10 per share. And you're basically saying, okay, what am I paying per dollar of earnings for this company? Now, fundamentally, a valuation ratio is actually a shortcut for a much more involved financial analysis known as a discounted cash flow methodology, where if you were a financial analyst, you'd actually build a really detailed financial model. You'd forecast out earnings over time based on, the guidance that the company gives you about what they're doing into the future and what their earnings growth rate and what their revenue growth rate is expected to be, what their profitability is expected to be. And you forecast out their earnings and their cash flow, and you use financial formulas to discount all that back to present value. A valuation ratio is basically a shortcut to all of that. And there's a formula that helps you kind of get to that, how you'd reduce it to that. But for what you need to basically understand is it's a way to more equally compare one company to another company on an apples to apples basis. Because it's sort of like saying, if you go up to a counter and you say, okay, I'd like some milk, please. And they say, I'm going to charge you $5. Well, $5, is that a good deal or a bad deal? Well, it depends, right, on how much milk are you getting? Are you getting a glass? Are you getting a gallon? You can kind of think of valuation ratios as the same way. It's making things comparable on a comparable basis from company to company. Some other valuation, so PE or price to earnings is kind of the most common valuation metric that you'll hear used. Other valuation metrics that you may hear bantered about are total enterprise value to EBIT or EBITDA. That basically is the total market cap of a company plus all of the company's debt relative to their earnings before interest and taxes, or in the case of EBITDA, earnings before interest, taxes, and depreciation and amortization. It's basically a way of looking at what is the total operating profit available to all stakeholders. So that would be debt holders, equity holders, as well as the government, right? Because they're going to take a piece of taxes that come out of that. That is usually a metric that we use when we're looking at if we're looking to do a leveraged buyout in the private equity world, or when we're valuing private companies because they don't have a public mark to market, right? And so that's usually a metric we use in those cases. Other ones you might see mentioned are things like free cash flow yield. So what is the free cash flow relative to the market cap of a company? I'm trying to think of some that are a little more antiquated and people use less frequently now are things like price to book. What are the total assets on the books of the company, on the company balance sheet, and how does that compare to the current market cap of a company? That tends to come into play more in like distress situations, or for really asset intensive businesses, more like in the industrial sector. They're kind of less relevant for companies in the service sector where their capital is more human capital. But so that's what a valuation ratio is. Those are some of the terms you may hear bantered about around valuation. Let me know if there's more questions about that.